Wall Street is now renting Blackwell. That is the strange part of Nvidia's next chapter. Not another hyperscaler buying GPUs. Not another lab training a frontier model. A major quantitative trading firm, Hudson River Trading, is getting access to more than 1,000 Nvidia Blackwell systems through Lambda, an AI cloud provider. The financial terms were not disclosed, and this does not mean HRT is handing live trading execution to an outside cloud. The official language is more careful. Research and development, model training, simulations, algorithm refinement. But that is exactly why the story matters. The most valuable customers in finance are not just buying chips. They are buying access to compute capacity that sits inside Nvidia's expanding ecosystem. The GPU is still the product. But increasingly, the strategic question is who routes access to that GPU, who packages it, who finances it, who networks it, and who makes it usable. The simple version of the Nvidia story is that the company sells the shovel in an AI gold rush. The more important version is that Nvidia is trying to own the roads, the toll booths, and the traffic system around the gold rush. This video is about that second story. Start with the HRT deal. Hudson River Trading is not a random customer. It is one of the most sophisticated quantitative trading firms in the world. Reuters reported that HRT generated about $12.3 billion in trading revenue in 2025. These firms compete by turning market data into hypotheses, testing those hypotheses, rejecting most of them, and moving the surviving signals into production. That sounds abstract, so make it concrete. A quant firm is not a magic AI machine that presses a button and prints money. It is a research factory. It ingests price data, order book data, news, alternative data, and internal trading data. It searches for patterns. It trains models. It simulates market conditions. It backtests strategies. It tries to find where a signal is robust and where it breaks. Compute matters because it increases the number of experiments the firm can run. If one team can test 10,000 ideas instead of 1,000, it may find better edges. If one simulation that took days now takes hours, the research loop gets tighter. If the model can be trained across more regimes and more instruments, the firm can stress test a strategy before real money is at risk. That is the clean way to understand the HRT-Lambda Nvidia triangle. This is not about AI replacing traders in one dramatic moment. It is about compute becoming the industrial base of financial research. And Nvidia wants to be the layer underneath that research machine. Lambda's announcement says HRT is using Nvidia HGX B200 systems, advanced networking, storage, and orchestration. Reuters adds that the deal involves more than 1,000 Blackwell systems. Those words matter because this is not just a chip sale. It is a packaged compute environment. The buyer of the chips may be Lambda. The end user may be HRT. The workload may be model training, simulation, and trading research. But the infrastructure stack, from GPU architecture to networking to software, remains Nvidia-shaped. That is the distribution story. For most of Nvidia's modern history, investors focused on units and margins. How many GPUs can Nvidia ship? What is the price? What is the gross margin? How much demand is coming from Microsoft, Amazon, Google, Meta, and the other hyperscalers? Those questions still matter, but they are no longer enough. In Nvidia's first quarter of fiscal 2027, the company reported $81.6 billion in revenue. Data center revenue alone was $75.2 billion, up 92% from a year earlier. More interesting than the headline number is how Nvidia now describes that business. The company split data center revenue into two broad groups. Hyperscale revenue was $37.9 billion. AI clouds, industrial and enterprise revenue was $37.4 billion. In other words, the non-hyperscaler side of Nvidia's data center business was nearly as large as the hyperscaler side. That is the opening for a different Nvidia story. The market has been trained to think about AI infrastructure as a battle between giant cloud companies. Microsoft has Azure. Amazon has AWS. Google has Google Cloud. Meta builds its own clusters. OpenAI, Anthropic, and xAI absorb enormous amounts of capacity. But Nvidia's customer map is getting wider. AI cloud specialists are raising capital, signing large contracts, and renting GPU capacity to labs, enterprises, and now elite financial firms. Industrial companies want AI factories. Governments want sovereign AI capacity. Banks and trading firms want model training and simulation infrastructure. The chip is no longer the only product. Access is the product. This is why DGX Cloud Lepton matters. Nvidia describes it as a compute marketplace that connects developers to a global ecosystem of Nvidia cloud partners. The partner list includes names like CoreWeave, Crusoe, Lambda, Nebius, Nscale, and others. Do not overstate this. Lepton is not proof that Nvidia already runs the main exchange for AI compute. The marketplace has to prove liquidity, price transparency, supply quality, and demand. But strategically, the signal is clear. Nvidia is not satisfied with selling chips to clouds and walking away. It wants a role in how customers discover GPU supply, compare providers, deploy workloads, and stay inside the Nvidia software ecosystem. That is a very different position from a normal semiconductor vendor. A normal chip company sells silicon into someone else's platform. Nvidia is trying to make the platform itself orbit around its silicon. The clearest evidence is networking. In the same quarter, Nvidia reported $14.8 billion in data center networking revenue under its previous sub-market categories. That was up 199% year over year. This is not a small accessory business anymore. Networking is part of how GPU clusters become usable AI factories. For training and simulation, raw GPU count is not the whole story. The GPUs have to communicate. The cluster has to stay predictable under heavy load. In multi-tenant AI clouds, different customers may compete for capacity. Across data centers, latency, congestion, scheduling, and reliability become economic variables. That is where products like InfiniBand, Spectrum-X Ethernet, NVLink, and related software matter. They are not just pipes, they are part of the control plane. If Nvidia can influence the GPU, the network, the software libraries, the orchestration layer, and the partner cloud ecosystem, then even when it is not selling directly to the final customer, it still has leverage over how the market is built. That is what HRT is really signaling. A trading firm does not need to care about Nvidia's narrative. It cares about performance, reliability, speed, and research throughput. If it rents Nvidia-based capacity through Lambda, while also being a major Google Cloud customer, it is effectively saying that serious financial workloads can move across cloud relationships as long as the compute environment delivers. That favors whoever makes the environment portable and high performance. Right now, that is Nvidia's advantage. CUDA, GPUs, networking, AI libraries, and partner clouds form a kind of gravitational field. Customers may buy from Lambda, rent from CoreWeave, use Google Cloud, or negotiate with another AI cloud. But if the workload is built around Nvidia's stack, the economic center of gravity stays close to Nvidia. This is where the capital markets implication becomes more interesting. If Nvidia is only a hardware cycle, then investors ask, when does demand peak? When do customers digest inventory? When do custom chips take share? When do margins normalize? End quote. Those are real risks. But if Nvidia is becoming a compute distribution layer, then the market also has to ask a different set of questions. How much AI cloud capacity is being built around Nvidia systems? How much of that capacity is financed by long-term customer commitments? How much networking attaches to every GPU cluster? How sticky is the software stack? Does Nvidia's marketplace become a real source of demand routing? Do enterprises and financial firms rent GPU capacity through Nvidia-adjacent partners instead of building everything themselves? That is why the HRT deal is bigger than its own contract. It is a proof point that AI compute demand is spreading into a high-margin, high-performance, non-AI lab customer segment. Wall Street does not need GPUs for the same reason OpenAI does. But it needs compute for a structurally similar reason: more experiments, faster iteration, larger models, better simulation, tighter feedback loops. Once that pattern repeats across industries, Nvidia's opportunity stops looking like one customer group buying chips. It starts looking like many industries plugging into a shared compute layer. Now, this is also where the risks become serious. The first risk is utilization. GPU clouds are expensive. If demand disappoints, capacity does not just sit politely on a shelf. It depreciates. It consumes power. It requires networking, operations, cooling, and financing. A cloud provider that overbuilds can be right about the long-term AI trend and still wrong about the timing. The second risk is financing. Lambda raised more than $1.5 billion in a Series E round and announced a multi-billion-dollar agreement with Microsoft to deploy AI infrastructure powered by tens of thousands of Nvidia GPUs. That is a sign of demand, but also a sign of capital intensity. AI cloud growth is not lightweight software growth. It is heavy infrastructure. The third risk is substitution. Hyperscalers are not passive. Google has TPUs. Amazon has Trainium and Inferentia. Microsoft has Maya. Meta is investing in its own silicon direction. Custom chips do not have to replace Nvidia everywhere to matter. They only have to take enough predictable workloads to pressure pricing or slow growth in certain segments. The fourth risk is concentration. Nvidia's customers are expanding, but the biggest buyers still matter enormously. If a handful of hyperscalers or AI labs slow orders, rework architectures, or delay data center buildouts because of power constraints, the ripple effect would be large. The fifth risk is geopolitics. Nvidia's China business remains constrained by export controls. In the Q1 fiscal 2027 commentary, Nvidia said its Q2 outlook did not assume any data center compute revenue from China. That is not a footnote. It is a reminder that this market is shaped by policy as much as technology. So, the right conclusion is not that Nvidia has solved every risk. The right conclusion is that Nvidia's strategic surface area is getting larger. It is no longer just asking customers to buy a better chip. It is helping create the financial, cloud, software, and network structure through which AI compute gets consumed. That is the shift investors should watch. The old question was, how many GPUs can Nvidia sell? The new question is, how much of the world's AI compute demand will pass through infrastructure that Nvidia helps define? HRT renting Blackwell capacity through Lambda is one answer. DGX Cloud Lepton is another. Networking revenue growing faster than the overall data center business is another. ACIE revenue, almost matching hyperscale revenue, is another. None of these points alone proves that Nvidia owns the future of compute. Together, they show the direction of travel. Nvidia is trying to turn compute from a product into a market. And in that market, the most powerful player may not be the company that owns every data center. It may be the company that defines the hardware, the network, the software stack, and the routes by which customers reach capacity. That is why a Quant trading cloud deal matters. It is not just Wall Street renting GPUs. It is a signal that Nvidia's next battlefield is compute distribution.